It's a big week, and it feels as though all eyes on some of these AI-focused names, the Microsofts and indeed the Alphabets.
Yeah, it's a huge week, Fed week, and all of these earnings coming in. It's really feeling like this is when the rubber hits the road. For a lot of these companies that have seen so much optimism and multiple expansion so far in 2023, the commentary out of earnings is going to be hugely important because if you look ahead to the end of 2023 and into 2024, earnings expectations are pretty high just across the board for the index. So companies are going to have to be able to justify the multiples that these stocks are trading at with their own expectations of what the next 12 months look like. So it's going to be a really sticky situation if they can't justify that. Some of the AI enthusiasm, my concern has been that when you have a new theme and a new innovation that is supposed to take the world by storm or just even change the marketplace a little bit, themes usually take 2 to 3 years to really materialize, and they go through a price discovery phase along the way. So I'm not sure that we're going to get justification and gratification of this AI theme in the next 6 to 12 months. And that's something that these companies will have to grapple with in the market.
I'm just thinking about price discovery. It was last week that Microsoft got a push higher in terms of its record market cap for itself because, well, they're starting to outline how they're going to price for some of the add-ons that we're getting with the Bing chat features. And it looked pretty toppy. People were impressed by the amount that they think they can charge. Ultimately, you've been impressed by the market capitalizations more broadly. Do you think that we have moved too far, too fast? Can we hold on to the level of outperformance in tech stocks that we saw in the first half of the year?
Well, when you've got an index like the NASDAQ 100 up 45% year to date, that's an outlier as far as performance goes. And I would say it's probably due for a little bit of steam coming out just because of how quickly things have run up. Expectations haven't changed too much from a fundamental perspective. So when you see that big dislocation, not only among different sized companies, so you've got large caps that really outpaced small caps, maybe until just recently. And when you've got certain sectors that handily outpaced other sectors, there usually is a little bit of mean reversion or just kind of closing that gap. Those big divergences don't last forever. So they do need to come back to a more rational place. Now, that doesn't necessarily mean that everything has to come crashing down. There's still an argument to be had, which a lot of the bulls will tell you, which is that the rest of the market can catch up rather than those big names having to come down. That being said, given the environment, given that we are on the precipice of what's expected to be another Fed hike, it just doesn't quite make sense, especially for those what we would call long duration equities to be trading at such lofty valuations when we haven't really finished the tightening cycle yet. Usually the market hits the skids a little bit when that tightening cycle stops.
Of course, today was the day we're meant to see the NASDAQ 100 rebalancing. It's occurred, maybe a little bit of volatility in the run-up, but did it make much changes for you? Do you think ultimately the NASDAQ 100 is a benchmark that can really be used for diversification?
I think it can be used. I mean, I don't know that it's something that necessarily is the epitome of diversification, given how top heavy it becomes at certain times, but that's just the nature of a market cap weighted index. The rebalancing, the actual day of rebalancing, obviously isn't having too much of an effect. I think a lot of that probably got baked in when the announcement was made. You can extrapolate what's going to happen. But over time, as things change and as prices move, that's just always going to be the case with a market cap weighted index, which is why sometimes it becomes more of a risk not to own some of those names because you're underexposed to what's really driving broad markets and driving investor sentiment.
Yeah, a lot of those actively managed mutual funds have been under pressure, according to the likes of Goldman Sachs. Lastly, what about protection? If you are worried that we've gone too far too fast, is it in any way, well, advantageous to be protecting the downside right now?
Sure. Well, I've been one of those people who was skeptical of this rally all the way up and have felt very, very wrong all the way up. But that being said, it is always good to have protection in the portfolio. I would say it's even better to have it in the portfolio when you have valuations above the 5, 10, and 15-year averages. And when you have a VIX that seems pretty asleep at the wheel, that's when it's kind of primed to spike. So although it feels like a ball and chain, it can feel like cement boots to put protection in the portfolio in the midst of a rally. That's really the time when protection is going to pay off more because maybe it's not under such strong demand. You can get it at a cheaper price, and then it's there if and when you need it.